Investment advisory services offered through Alpha Star Capital Management, LLC, an SEC-registered investment advisor. Alpha Star Capital Management, LLC, and Swan Capital are independent entities.
What your money would say. Andrew McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say. I'm your host, Andrew McNair, and for the next 30 minutes, every Saturday from 12:30 to 1 o'clock, we'll be taking financial chickens and making them financial swans, because we believe at Swan Capital, my wealth management firm, and What Your Money Would Say, as a retiree, you deserve to sleep well at night. After putting 3 kids through college, saving in your 401k plan, and even giving to your charity and your church along the way, we believe in retirement, you need guarantees in a world of uncertainty. And today we're going to talk about an often really uncertain and scary topic, taxes. And we're going to bring on a good friend of mine, Tina Patterson-Reece, a local CPA, and we're going to talk extensively about retiree tax planning. But before we do that, I want to share with you some upcoming events we have here at Swan Capital. And that is our Veteran Aid in Attendance Workshop. And that's going to be at the Sable House, November 26th at 6 o'clock. So if you are a veteran and are over age 65 or a widower of a veteran, you want to make sure that you don't miss this workshop. We're going to talk about ways where you can receive up to $24,000 a year tax-free from the VA to help pay for assisted living, nursing home, and home health care. And those funds can be used however you want to spend them. So you don't want to miss that workshop. It's going to be November 26th at 6 o'clock. So it's coming up. Now, in the meantime, I want to share with you that the lines are open here on What Your Money Would Say. The phone number is 478-3116. That's 478-3116. And we'll be happy to answer your retirement, estate planning, and tax planning questions live on the air. Now, looking forward to having Tina Patterson-Reece on for a while, because as we approach the end of the year, there's a lot of tax planning that needs to be done. So welcome to the show, Tina. Now, Tina, if you'll start off and share with us a little bit about yourself and your practice.
Okay. I've been practicing public accounting since 1992 in Pensacola. I have a firm. It is Yeagle and Patterson-Reece. It is a very small little firm, my partner and I, and we have a staff person that works with us. So when you come into our office, you're talking to me. You talk to me, and I deal with taxes. I have some clients that are small businesses. I see everything. Anybody that walks in, I answer all questions.
So everything under the sun. And here's a great testimony. I use Tina personally. And I just love how she runs her practice, because it's instead of being passed off to some junior associate, I actually always get to deal with Tina, which is just fabulous. If you know how taxes can be so frustrating and so confusing, it's nice to have a consistent one person that you can say, hey, Tina, I got this question. What do I need to do? So Tina's been valuable for myself countless times. But today we're talking about retiree tax planning. Okay. And from your experience, how has tax planning different for a retiree than it is for a general population? Do you find that they're more uncertain?
I think they are. I think people are worried, is my money going to make it? Am I going to be able to get through this retirement? Should I have retired then? And a lot of questions I get are right before, maybe a year or two before people decide they are going to retire, and they want to know what are their taxes going to look like going down the line.
And you brought up a good point, is outliving your money. See, if you have taxes just bleeding out and you're on fixed income, you can't just go back to work, or you might not want to go back to work. So when you get to retirement, it's all about making sure that you outlive your money and not the opposite way.
Right.
Now, as we approach 2014, I can't even believe that Turkey Day is just in a few weeks.
And I'm ready for it.
But then you got to start all over. April 15th will come real fast, won't it?
Yeah. It's like we have November, December, and then you hit January, and you're off and running all over again. It starts all over again, and you're just running for April 15th. So.
The race. Now, as we approach this 2014, what are some things that, as a retiree, you should look at and make sure that it's checked off? I mean, potentially maybe some RMDs. I know a lot of families that are coming to my office saying, hey, we haven't taken our RMDs, and, we might not even heard from our advisor about taking those RMDs, and that's something critical that you want to take.
You have to get it done by December 31st. You absolutely, that's just one of those things. If you don't, you get all kinds of penalties.
And it's one of those where you don't want to wait till December 31st because it takes a while to process.
I've had that too. In fact, and I had one client that he had contacted his advisor and said, I do my RMD, and he waited towards the end and then realized whenever he looked at the notice that came after the year that they hadn't done it quite right. So we had to correct it after the year.
And that can be hugely expensive, because if it's not taken care of after the fact, it could be a 50% penalty.
Yep.
And isn't that crazy? It's your money, and you have to pay the taxes, and you have to pay a 50% penalty. So you don't want to mess up your RMDs as we approach the end of the year. Also, last-minute gifts. If you're a grandfather and you want to give potentially some money to your children, your grandchildren, at the end of the year, if you haven't made your gift already, it's a perfect time to do it.
Yep. Give them that gift. Let them start the year out with your money.
There you go. I like that. And my name's Andrew McNair, if you're just looking for someone to gift money to. Also,
right after you give it to me.
Right. Contributions to retirement accounts. So maybe if you've only given $2,500 to your IRA, this is a perfect time at the end of the year to lower your taxes for the following year on making that contribution to your IRA.
Mm-hmm. Yep.
And the figures, and we're going to go into the 2014 figures, but 2013, it's 17.5 for IRAs and 401ks.
Right.
So if you're just tuning in to today on What Your Money Would Say, we have Tina Patterson-Reece, a local CPA and a good friend of mine, and we're talking about retiree tax planning and some of those fine things that you need to tune up right before 2014 comes upon us. And we talked about you need to make sure that your RMDs have been taken. You need to make sure that you've done the last-minute gifts. And we're going to talk extensively about how gift taxes work. We talked about contributions to retirement accounts. You want to make sure that those are all done. Now, as we approach 2014, it seems like we have a new tax on our hands, the Obamacare tax. Could you talk briefly about what families can expect there?
Well, what are they telling us? Either you get this health insurance that you're required to have, or you're going to get hit with a penalty. So, and that's even in it's starting in 2014. You'll get hit with the penalty. And what were we saying? It's like $95 or 1% of your taxable income?
Which can be a lot. 1% of your income. Let's say you're making $100,000 today or $50,000. That's, $500 to $1,000 in taxes that you were not paying before. And I love, we are never going to tax you for this health care plan. It's a penalty. Isn't that so nice? So you want to make sure that you're prepared for that, and it's not a surprise. I knew it was a surprise for me when I was thinking about 2014 tax year planning. So you want to make sure that you're prepared for this Obamacare tax that's coming up. And if you can actually sign up for healthcare, right? Healthcare.gov is probably closed right now.
It is a little interesting, but hopefully they'll work it out.
We're going to take a quick break, but we'll be right back, and we're going to talk about ways to reduce your federal income tax for 2013.
Okay.
Today's financial landscape can be rough. One of the most important aspects of planning is choosing the right guide to help you navigate the road to retirement. Andrew McNair and the team at Swan Capital is dedicated to providing the very best service in the retirement planning industry today. Swan Capital is a full-service independent wealth management firm dedicated to providing guaranteed custom income plans that you cannot outlive. Contact Andrew McNair at Swan Capital 850-380-9558. That's 850-380-9558. The difference between Swan Capital and you retire once. We help people retire every day. You should be enjoying your retirement years, not letting worry keep you up at night. Swan Capital. Sleep well at night. Contact Andrew McNair at Swan Capital 850-380-9558. That's 850-380-9558. 850-380-9558. Again, that's 850-380-9558.
The Veteran Benefit Project, founded by Andrew McNair, president of Swan Capital, is a nonprofit organization dedicated to helping veterans and widows of veterans with long-term care expenses by qualifying for the VA's Aid and Attendance Benefit. Learn how to receive over $24,000 per year from the VA towards long-term health care. There is absolutely no fee associated with our assistance to the veteran, the widow of a veteran, their families, or any retirement community. Our goal is to preserve the dignity of the veteran and to reduce the dependency on the Medicaid system. Again, learn how to receive over $24,000 per year from the VA. Contact the Veteran Benefit Project 850-380-5137. That's 850-380-5137. 850-380-5137. Look us up on the web, myveteranbenefit.com. At the Veteran Benefit Project, we are committed to helping you secure the benefits you deserve.
Welcome back to What Your Money Would Say. On today's show, we're talking about retiree tax planning. We have Tina Patterson-Reece here, a good friend of mine and a CPA, local here. And we're talking about federal income tax and how you can reduce it for 2013. Well, let's jump into itemized deductions versus standard deduction.
Okay. All right. Itemized deductions. If your itemized deductions are more than your standard deduction, which I think we said was $12,500. $12,000. Then here it is, $12,200 for married filing jointly, and then if you're over 65, you get another $1,200 tacked onto it. So if your itemized deductions are more than the $13,400, if you're over 65, then you would itemize instead of taking your standard deduction. So how are we what are some of the things that you're looking for as far as itemized deductions?
Yeah, what's an itemized deduction? What's not an itemized?
What's an itemized deduction?
That gives people a good idea.
All right, you're going to have medical expenses. Your medical expenses are, in the past, they've always been, if you get over 7.5% of your adjusted gross income for medical expenses, then you could take the deduction. One of the things that's changed this year is if you are under 65, that threshold is now not 7.5%, but 10% of your adjusted gross income. So that means your medical expenses have to be 10% of your adjusted gross income. If you're 65, it stays at 7.5% until 2016.
Which affects millions. I mean, that's a little, they slid that one in because that is a huge one. That means if you don't reach that point, then those couldn't be counted. Now, what is a medical deduction and what's not? I mean, if I want to get a nose job or maybe some nice plastic surgery for a wife, does that count?
No.
What would count as a medical expense?
If you go to the doctor, I mean, just your dental bills, that kind of thing. There are some other more interesting, but
typically necessary things. Now, would assisted living, nursing home expenses, would that be considered necessary?
Everything says it depends. It depends. If you're going to a nice little retirement home and all you want to do is live there and you don't need the medical assistance, then does it count? No. No,
because they're not offering any medical or help with your ADLs. And I have a lot of families that come to me and they say, well, can I count this on my tax return? Yes, if they're helping out with your ADLs, they're helping out because you have a medical need and you need these things. So you want to make sure if your parent is living in an assisted living nursing home or getting some high-level home health care, you need to make sure that to see if it's a medical expense. Also about charitable deductions. What's considered a charity and what's not? I guess that's a big spectrum, right?
Yeah. Let's see. Your churches, any kind of, known, recognized 501c3, then you're good. Now, one of the things I was telling you earlier, so I've had clients that they buy Girl Scout cookies and they'll put it on their list of their itemized deductions. I can tell you that doesn't count.
So darn, I can't count my Thin Mints as a contribution, huh?
Nope.
As a charitable deduction. Oh, man.
Because the IRS says you got to enjoy those Thin Mints, so you can't deduct it. So.
Well, darn, I did enjoy them, but I guess I can't count them. Well, the next thing we're going to talk about is the RMD mentality, and this is something I've kind of created or stole from someone. I guess there's no original ideas out there, but the RMD mentality is, as a CPA, and this is the secret, is if you can lower a client's taxes in 1 year, you're a hero. Right. They say, everyone, you got to go see Tina. She lowered it in 1 year. But sometimes if you're focused on the tree, you miss the forest on tax savings. Do you ever see that in your world?
Oh, yes. Oh, yeah. Like I've said, so people say, I want to lower my taxes. They'll run out. Should I go out and buy something? Well, it depends. Do you need that something? So you just save 25 cents in taxes, but you spend $1. So,
right. Like going in debt to increase your credit score. It doesn't make sense. You're doing more harm than good.
Right.
So you got to balance that. When I talk about the RMD mentality, most of my clients are all 55 and above, and they have invested into an IRA, or they're continuing to invest in the IRA. But when they get to age 60 and then eventually 70, where they have to take their RMD, which stands for required minimum distribution, they have to take out that withdrawal, or they get hit with that 50% penalty.
Right.
And so what they do, is I find, is they take out just the little bit they can, and their CPA says, yeah, just continue taking out the little bit you can, because if you do, you're going to pick out more taxes because it's income tax. But what I share with families is basically, visualize a pie. Right now, if you have an IRA, Uncle Sam owns 20% of your IRA. Now, let me ask you, Tina, do you think tax rates are going higher or lower?
I think they're going higher.
It seems like we've promised more and more as a country, and it's got to come from somewhere. And I like to think about it as a person. The government throws around these billions of dollars spent, but I mean, just take it to a personal level. If you are making $50,000, but you're spending $70,000, but you're in debt to $120,000, you're in debt to your eyeballs. It's either got to increase income or you got to cut your expenses. And like we talked about off the air, no one wants to cut the expenses because you're going to say, well, not my backyard. Mm-hmm. And then so taxes have to come from somewhere. So if you believe that tax rates are going higher and Uncle Sam already owns and has a 20% lien on your IRA, do you want to wait till he now owns 40% of your IRA? See, that's the RMD mentality, is that we're just going to take out the required minimum distribution and we're just going to let it on smooth sail and take out the smallest we can, which it makes, a lot of times taxes look great. You're saying you're just taking out the littlest you can, but it's not a lot of times the most tax efficient way to pull out your money over a lifetime and save money in taxes.
Right. That's true.
So what I want to do is encourage you, if you have an IRA today and you're saying, Andrew, I think tax rates are going higher, what do I do? Call Swan Capital at 380-9558. That's 850-380-9558, and we'll help you create an exit IRA plan where you can get out of your IRA over a 5 to 10 year period and not worry about what Congress is going to do with your tax rates. Because when you get to retirement, again, you want more guarantees in a world of uncertainty. The next thing I want to talk about is gift taxes. Now, gift taxes can be such a confusing topic for so many families. Can you share with us what the gift tax is all about?
Okay. So you have estate and gift. They're joined together. So what that means is right now the limit is, what did you say, It's
$5.25 million over a lifetime and $14,000 for this year.
Right. The gift tax, the amount that you can gift to someone is $14,000 in 2013, and they're thinking that's going to stay the same for 2014 also. So I have people that call me up and they say, if I give $14,000 to my kid, do I get it to deduct it on my tax return? The answer is no, you don't. So
now sometimes you feel like your kid's a charity, but doesn't mean you get a deduction.
You don't get the deduction. So then I hear, well, do I have to file a gift tax return? Well, if it's $14,000 to a person, then no, you don't. So you can go out and give $14,000 to 100 people you meet on the street, and you're still okay. You don't have to file a gift
Again,
tax.
that's Andrew McNair. If you're just giving around $14,000 like a Secret Santa, I appreciate that. But most people don't think that. They think if I give any gift at all, I'm going to have to claim it.
No. And so what if you say, well, I have a daughter, me, who I want to help her buy a house. So I'm going to give her, she doesn't need 14, she needs more than that. I'm going to give her 25. What does that mean? Well,
and I have tons of clients that say, well, Andrew, I'm not going to have to pay taxes.
No. well, no, it depends. If you have gifted more than your, what is it, the
5.25 million,
and it's going up. That's the reason I keep.
Right. It's 2012 is a different number. 13. It always goes up.
Right. So if you haven't gifted away all your
lifetime exemption,
then you give them $25,000. You're going to have to do a gift tax return. Do I owe taxes? No. All you have to do is confess to the IRS that you gave her $25,000. That's it.
Right. And so what they do is, let's say I do give my son or daughter, $25,000. And that is over the $14,000 that I do have to claim. Well, they just take that from the lifetime exemption. Mm-hmm. So many families say, well, my mother has $500,000 and we're looking at maybe some Medicaid planning or some VA planning. We want to gift that money to the kids and make sure that they start, we want to see our legacy lived and not just die and have, the most money in the graveyard. So they want to start giving out the money, but they're worried about taxes. And if you deal with an experienced financial advisor that deals with distribution and conservation, which is what my specialty is I'll share with you that that's not the case. You don't have to be worried about taxes when you're gifting, because you can give that, and as long as you don't give over $5.25 million, there's nothing to really worry about. You just have to report it.
Right. And your kids don't have to pick it up as an income. That's the other thing.
Which is huge.
Can I deduct it, and can my kids have to pick it up in income? And the answer is still no, no, no.
Exactly. All those questions we get asked, kind of the confessions of the CPA and the financial advisor. Many families always ask us, who's going to have to pay the taxes? The answer is no one up until the $5.25 million, but you do have to let the IRS know. Now, what's nice is, and we talked about this, if you're married, you actually can give more, and also you can give to different people.
Right. So if you're married and you're trying to give your daughter that $25,000, you give the 14 and your
husband or spouse
does the rest of it, and then the 11 you got them 25, and you still don't have to do a gift tax return. If she's married and you say, we need to give her a lot more money, you can give 14. Your husband gives 14 to your daughter. You give 14 to your daughter, 14 to the spouse, 14 to the spouse.
Which is fantastic for a lot of families that, again, want to see their legacy lived out. When it comes to estimated key figures for 2014, do you think we're going to see a lot of changes? Social Security got a raise with the CPI, but just because the Social Security and government benefits got a raise doesn't mean that all these exemptions or exclusions
your standard deduction, it always goes up. Your exemption, it goes up. But some of these things, some of the numbers are indexed and some of them aren't. So
it's just on a whim they raise them.
Well, I don't understand all the rules, but all the reasons why they leave some things set and but yes.
It is interesting. So the contributions to IRA 401k are going to stay the same at $17,500 for next year. Gift exclusions are estimated to still stay at $14,000. But there's also some, again, we talked about this briefly, you need to know that there's going to be future taxes that are levied on you, next year that weren't necessarily levied on this year, aka Obamacare tax. Penalty, sorry. Yes, or the penalty. So you need to be aware of that one because you need to expect what's going to happen. Going back to what we were talking about, the RMD mentality, creating an IRA exit plan, I want to kind of stop and give you a history of what the IRS has done over the last 100 or so years. We forget that federal income tax, was a temporary tax. Mm-hmm. But it doesn't seem like it's very temporary, does it, Tina?
No, it's been around as long as I know.
Which is good for CPAs, and it's a good job security. They just keep it going. But the history of the top marginal tax bracket, I implore you to encourage you to definitely Google that. Right now I have so many families that say we're at, so much, taxes are so high. They're just now at 40%. Gosh, I couldn't imagine them going higher. But believe me, they did, and they could do it again. When IRAs and 401ks were invented, taxes were up at 70%. See, it made sense to tax defer your retirement. But if you're still using that same advice that you read in Money Magazine that says tax defer your money, I encourage you to challenge those ideas. And if you have a question about that, give the station a call at 478-3116. That's 478-3116. and we'll be happy to talk with you about your tax plan and your retirement plan. Again, I want to talk a recap on what we talked about today. We talked about the perception for retirees, Tina. We talked about as a retiree, you can't necessarily go back to work like you did, or you don't want to. So getting your tax planning in order, your tax house in order, is so imperative. Because when you get to retirement, again, you want more guarantees in a world of uncertainty, and you don't want to have all these tax liabilities. If you can pay the taxes now, let's do it. We talked about some end-of-year tax planning. We talked about that RMDs. You need to make sure that that's taken care of. We also talked about last-minute gifts and then contributions to your retirement accounts. And then finally, we wrapped up when we talked about the RMD mentality. Families are so often, I see, taking out just the required minimum distribution, and they're missing the forest by focusing on the tree. They say, Andrew, I have to lower my taxes. Well, you need to focus on lowering your taxes over a lifetime. So if you have any questions about your retirement plan in relation to taxes, give our office, Swan Capital, a call at 380-9558. That's 380-9558, and we'll be happy to talk with you. I'm going to wrap up. I want to first thank you so much, Tina, for coming on the show.
Thank you.
And share with you that about our Veteran Benefit Workshop that's coming up on November 26th. It's going to be at 6 o'clock at Sable House, and we're going to share with families how you can receive up to $24,000 a year from the VA to help pay for assisted living, nursing home, or home health care expenses. So you don't want to miss that workshop. You can find out more information at swan-capital.com. Sign up for our market update that comes out every week, and follow us on Facebook, and like us on Facebook, follow us on Twitter. All right, I'll see you next time on What Your Money Would Say.
Today's financial landscape can be rough. One of the most important aspects of planning is choosing the right guide to help you navigate the road to retirement. Andrew McNair and the team at Swan Capital is dedicated to providing the very best service in the retirement planning industry today. Swan Capital is a full-service independent wealth management firm dedicated to providing guaranteed custom income plans that you cannot outlive. Contact Andrew McNair at Swan Capital 850-380-9558. That's 850-380-9558. The difference between Swan Capital and you retire once. We help people retire every day. You should be enjoying your retirement years, not letting worry keep you up at night. Swan Capital. Sleep well at night. Contact Andrew McNair at Swan Capital 850-380-9558. That's 850-380-9558. Again, that's 850-380-9558.
The Veteran Benefit Project, founded by Andrew McNair, president of Swan Capital, is a nonprofit organization dedicated to helping veterans and widows of veterans with long-term care expenses by qualifying for the VA's Aid and Attendance Benefit. Learn how to receive over $24,000 per year from the VA towards long-term health care. There is absolutely no fee associated with our assistance to the veteran, the widow of a veteran, their families, or any retirement community. Our goal is to preserve the dignity of the veteran and to reduce the dependency on the Medicaid system. Again, learn how to receive over $24,000 per year from the VA. Contact the Veteran Benefit Project 850-380-5137. That's 850-380-5137. 850-380-5137. Look us up on the web, myveteranbenefit.com. At the Veteran Benefit Project, we are committed to helping you secure the benefits you deserve.